Let's talk about stocks. Stocks are fractional pieces of ownership of publicly traded companies. So even if you just own one share of a company, you're already a shareholder and therefore a part owner of the company. Companies are issuing stocks to investors to raise money. So they give away equity in exchange for fiat currencies like US dollars or euros. And they use these fiat currencies to acquire other companies, to improve their product and services, to hire new talent, to get into new markets and so on. And basically, getting ahead of their competition. The stock market is a very well regulated, deep and liquid market. And there are over 40,000 publicly listed stocks all across the world. And of course, diverging quite drastically in market capitalization and popularity. But you'll find the biggest stock exchange in the US, in New York, in Chicago, in Europe, in London, but also Tokyo, Shanghai, and so on. And we'll cover stock exchanges in another lesson later on in this course. And if you ever thought what's actually driving the value of a stock of a company, the core value driver is the business value of the underlying company. That means, is the product or service of the company in demand? Is the demand rising? Is the demand falling? How's the competition positioned of this company? Is it affected by regulation? Is it a growth market like renewable energy? Is it a declining market like fossil fuels? This is what's mainly affecting the valuation of certain companies. But also we have to mention here that these days we are in a very low interest environment, which means that credit is pretty cheap. So money is pretty cheap and credit is for many people very easily available. And these led to also excessive borrowing from investors, both from private investors, but also from institutional investors. So basically to use credit as a leverage to even buy more stocks within the stock market and just have a small percentage of own capital for investing. And this is also a major influencer of stock market valuations and therefore valuations of single companies as well. Here in this slide, I want to show you the historical returns of the S&P 500 from 1928 to 2021. The S&P 500 is the Standard & Poor 500 index, which is representing the 500 biggest companies in the US by market capitalization. So if we start here in 1928, you see there was a extraordinary successful year for stock investors in the S&P 500 in 1928 with nearly a 40% gain. This was building up all over the 20s, which are often considered the roaring 20s, where there was a lot of optimism in the economy. It was easy to get credit, a lot of growth after World War I. And this enthusiastic phase unfortunately stopped towards the end of the 20s in 1929, where in October the Black Thursday kicked in and led to the Great Depression, as it is referred today, and a 4-year decline of the S&P 500. A very dramatical one here in 1931, where the S&P 500 nearly lost half of its value. So within these 4 years, about 85% of the value of the S&P 500 has been erased. Then you had successful years leading up towards World War II. This was a quite challenging time, obviously, with very moderate returns or even like bad years for the stock market. But then we had a stabilization after World War II with very good returns of nearly up to 50% here in the mid-50s. And what's a very significant year for you to know is the year 1971. This is when President Nixon was canceling the gold standard, basically that the US dollar needs to be tied to the amount of available gold on the world. And this was happening in 1971 in August. And this actually was the birth of fiat currency, which means fiat money as we know it today with dollars and euros and so on hasn't been tied to any physical commodity like gold, and therefore it could be printed in excess, and there was no limit of creating new money since it wasn't tied anymore to anything. And when you look to the returns of the S&P 500 since 1971, it's quite clear that there has been way more positive years in terms of returns than negative ones. Also, if you compare the time from 1928 to 1971, you see that there have been more negative years than from 1971 going onwards, which could give you an indication that this really huge impact on the monetary system was very favorable for stock market investors. But right shortly after the decision to get away from the gold standard in 1973, we had the oil crisis with the oil embargo and the OPEC crisis, that the Organization of Petroleum Exporting Countries, short OPEC, was deciding to stop exports to countries which help Israel, and therefore oil prices all over the world were shooting through the roof, which led to a near financial crisis and to very negative returns on the stock markets. This was compensated in the next couple of years, and the next major downturns in the US stock market was around the 2000s, where the so-called .com bubble bursted. So the internet went online in the early 90s, Tim Berners-Lee, and then companies started to build websites and so on, and there was really a hype around the internet, and especially in the second half of the 1990s, every company which had this .com in their name seemed to be like a high flyer, and there was incredible valuations towards the end of the 90s, pets.com and as they are all called. But this came to a halt in 2000, in March 2000, where this .com bubble bursted. And this went on for the next 3 years, actually. Here in 2000, the .com bubble bursted. In 2001, on top of it, you had 9/11. And then on 2002, you had the worst decline of all the 3 years, but then a recovery over the next couple of years until 2008, where the Great Recession hit, fueled by very low regulations when it comes to credits for people wanting to buy a house. So you had the real estate crisis there, that especially since the 2000s, credit for real estate investors and owners have been available very easily and loosely. And the banks and insurance companies even speculated with these credits giving out to borrowers, with so-called mortgage-backed securities, which have been very toxic products, and finally led to this huge downturn in the economy, where the S&P 500 lost nearly 40%. Back then we hit 0% interest rates from the Federal Reserve, and as you can see, the result was that the stock market was returning quite impressively. And since 2008, we only had 2 moderate negative years in the S&P 500, in the year 2015 in the single-digit area, and in the year 2018, where we saw a downturn in December. And even the Corona crisis, which hit in 2020, was not severe enough to lead to a negative return in the S&P 500. So overall, you see there have been way more positive years than negative years in the S&P 500, with some major crises like the Great Depression, World War II, the oil embargo, the dot-com crash, and the Great Recession in 2008. And if you look at these last 90 years, the average return of the S&P 500 was around 8% per year. That means if you put your money in the S&P 500 in 1928, you would have returned on average 8% annually. In this lesson, I want to speak about the returns of technology stocks in a time period from 2017 to 2022. I listed the 5 companies: Apple, Microsoft, Amazon, Netflix, and Salesforce. As you can see, in 2017, they started at a very similar level and all developed pretty well from the view of the shareholders. Apple returned over 450% over the last 5 years, Microsoft nearly 400%, Amazon nearly 300%, and also Netflix and Salesforce with amazing returns of over 200%. So on average, if we look at these 5 companies, the compound average growth rate have been about 25%, which means on average, they were returning 25% to their investors. And if you think back about the lesson on the S&P 500 and the performance of the S&P 500 over the last 90 years, we had an average return rate of 8% per year. So here you see the difference between a more like conservative investment in an index fund like the S&P 500 and a return of 8%, or a more risky, volatile investment in technology stocks with a return of 25%. So this illustrates quite in a nice way that by investing in technology, you have kind of a higher risk, but also the returns can be quite handsomely, as we see with these 5 companies. And during the next lessons and modules, you'll learn what kind of technologies are out there apart from these 5 companies, what I identified as the megatrends and major growth areas, and what kind of annual returns will be possible there. This lesson, we're going to speak about value and growth stocks as well as dividends. Value stocks tend to trade at a lower price relative to their fundamentals, such as earnings and sales. So value stocks typically are very established, huge companies, which many people are familiar with. To name examples here are Apple or Bank of America and so on. There are different interpretations how to classify a value stock. Some people think they are obviously undervalued due to their fundamentals, like if you look at ratios like PE, like price to earnings ratio. So how much does the stock cost compared to what the company is earning? Some others argue that they are well established but slowly growing. And in our case, we use this expression value stocks throughout the course, that these are valuable companies which are kind of mature, but are still about to deliver solid returns over the upcoming years. Growth stocks are kind of the contrast to value stocks. So a growth stock is any share in a company that's anticipated to grow at a rate significantly above the average growth for the market. So if you remember the example before with the S&P 500 and the technology stocks, you could think of the S&P 500 as a value stock, and you can think about the technology stocks as growth stocks. So technology stocks, or in this case growth stocks, they are way more volatile and also more risky to invest in. But if you choose the right companies, the return potential is also way higher compared to value stocks. So growth stocks are typically young companies which are just entered the public market, technology stocks and stocks in fast-growing industries. And as mentioned before, they tend to have very high volatility, but over the long run often turn out to be fantastic investments. Dividends are payments made by publicly listed companies as a reward to investors for putting their money into the venture. So dividends are basically a fixed payment which the company is making to its investors on an annual or biannual basis. So, for example, if a company is paying a dividend of 2% and an investor puts in $100,000, he gets $2,000 every year as a dividend, independently how the company is going to perform. So it doesn't matter if the stock price is higher or lower than at the time of the investment from the investor. The dividends are fixed, and this is especially interesting for people who are looking for fixed income or big institutional investors who move a lot of capital around, that they have these fixed calculable income. And usually big mature companies offer attractive dividends, while young and high growth stocks often don't pay any dividends. Tesla or Google, for example, are not paying any dividends. Yeah, so this is in a nutshell what are value stocks, what are growth stocks, and what are dividends. And during the whole course, we're gonna focus mainly on growth stocks, but you'll also see very interesting value stocks you can invest in. Yeah, in this lesson, I wanna speak with you about stock exchange, initial public offering, and SPACs. Yes, a stock exchange in general is a central marketplace for brokers, traders, and investors to buy and sell securities. So on the left side, you see the New York Stock Exchange, which is the biggest stock exchange by trading volume in the world. And as you see here, there are a lot of like monitors and computers standing around, and most of the trading is happening there electronically today and is done by algorithms in microseconds. While back in the days, 40, 50 years ago, people were standing there on the grounds and giving their bid and ask orders, and brokers on the tables accepting them and so on. But nowadays, this is mainly done electronically via very smart quants and algorithms. An initial public offering, an IPO, is the process of offering shares of a private corporation to the public in a new stock issuance. So a company which have been private until this day, funded by venture capital, angel investors, and so on, decide to go public and offer equity in form of shares to the overall public. This is called an IPO. Most of the time, this is the case when the company reached a certain size. They have a lot of revenues, and they comply with the regulations from the SEC, the Security and Exchange Commission, if you want to go online, if you want to go public in the US. On the contrast, a SPAC is a special purpose acquisition company, and this is formed strictly to raise capital through an IPO for the purpose of acquiring an existing company. So the SPAC, the Special Purpose Acquisition Company, which is also referred to as a sponsor, is collecting funds from investors with the promise of acquiring a company which is not publicly listed yet, and therefore is accelerating the process of these not yet publicly listed company to be available and to be tradable via the public market, and therefore kind of circumventing the regulations from the SEC, which are oftentimes very complicated and costly for young companies. So especially in 2021, there has been a huge wave of spec deals and lots of acquisitions on there. But as it turned out, the majority of them really collapsed after they went online, since most of the time these were very young and immature companies, which in some cases didn't even generate revenues and so on, and were just active in very hot fields like electric mobility, hydrogen, and so on. So yeah, specs are something you need to be really careful of, and yeah, IPOs are more regulated and therefore more trustworthy if you wanna buy and sell securities on a stock exchange. Let's speak about bonds. So what can you imagine is a bond? This gentleman? No, it's not. A bond is a loan given to a company or a government by an investor. So basically, if governments or companies want to raise money, they can issue a bond, and therefore we distinguish between corporate bonds and governmental bonds. You can consider it being a fixed income with predetermined interest rates, which is also called the coupon rate, and regulatory scheduled payments. So the government or a company is telling you exactly what you can expect to earn by giving them money, and this is being paid out usually on a biannual basis. It's less risky compared to stocks, and very often used for portfolio diversification. Especially big institutional investors like to invest in bonds, since they are not as risky and offer stable income. But for very, very stable governments like Germany or Switzerland or even the US, the rates for bonds have declined quite drastically in recent years, and some even yield negative rates, which means you actually lose money by investing in these bonds, which obviously make them not as attractive anymore as they used to be. The two main criteria to invest in bonds are the so-called credit worthiness of the bond issuer and the yield. And we're going to have a look at these two criteria in detail in the next lesson. In this lesson, I want to briefly touch on the concepts of credit worthiness and yield. So on the top right, you see a graph which is representing the credit worthiness of a bond issuer on the y-axis and the yield on the x-axis. So starting on the top, a US 10-year governmental bond is considered being very credit worthy because it's the US government, but has a rather low expected yield with 1.5%. Then Siemens, German engineering company, very creditworthy, is issuing corporate bonds with an expected yield of 2.7%. MAN, German trucking company, also pretty creditworthy, offering corporate bonds with 3.2%. And then on the bottom right, you have Argentina, which is offering a 10-year governmental bond similar to the one of the US. But here the expected yield is nearly 50%. So why is this the case? Because Argentina is being considered very low when it comes to credit worthiness, and an investment in Argentinian governmental bonds are considered highly risky and therefore offer these high yields since they're already called speculative. Speaking about the description of bond investments, there are rating agencies. The three most powerful ones are Moody's, Standard & Poor's, and Fitch. And they came up with these rating mechanisms to give investors an indication about the quality of their investments. So AAA signifies the best quality of the bond issuer. AA is still high quality. Single A is upper to medium grade investments. And when it comes to BBB, this is called still investment grade and investable. But everything below BBB is being called speculative or even junk bonds. So these rating agencies have quite high power to decide if a government or corporation is being considered investable, and they have huge influence on their credit worthiness. So to sum up, bonds can be issued by both governments and corporations, and investors should always look out for the credit worthiness and the perfect combination of creditworthiness and expected yield, but also consider the current inflation, because today, like in spring 2022, we have an inflation of about 5 to 6%. So if you're yielding 2 or 3% with a bond, you still lose money because you're not outperforming the inflation. So this is some thought processes which are very important for you to consider as an investor. Let's speak about real estate investing. Yeah, investments in real estate are investments in physical infrastructure. So you can literally touch the investment, you can see it, you can feel the investment, but you're also tied to it physically. Because as you say in German, Immobilien, they are not mobile. You cannot move them, except maybe for newer developments like mobile tiny homes and this kind of stuff. But usually when you invest in a house, you're tied to the location. For the average household in North America and Europe, this is the largest source of wealth, because the majority of the net worth of an individual is oftentimes parked in a private home. Real estate offers significant return potential in large part due to high debt leverage, which means for many banks it's sufficient if you pay down like 10% of the overall price of a house with your own equity capital, and they give you the other 90% with debt capital, and then you just have the mortgage and pay it back over like 15, 20, 30 years. And that's why also in recent years we saw quite a boom in major cities all around the world, since there was not a lot of equity capital necessary for many private investors, but also institutional investors. And real estate turned out to be really attractive investments for the last couple of years. And today many people think they are already in bubble territory, but this is yet to be seen. Value drivers of real estate are the scarcity, like how many houses and apartments are available in a certain areas. What about the location of the houses? Is it next to a park, next to a lake? Is it in the woods? Is it up on the mountain? How is like public transportation available close to the house or the apartment you're thinking about buying? Also the job market, are there good, attractive and well-paid job in the region? Also, if you want to invest in a house and rent it out, you have to consider, are the people who are likely to rent the house, can they get good jobs with stable income for paying your rent? You also have to consider the crime rates. Is it safe to live in the area? The school quality, if your kids can go to good schools, and also property taxes. If the government or the local government in this case is rather punishing real estate owners, or it's very attractive for you to go into this market and buy real estate. In this lesson, I want to briefly describe to you what kind of real estate is existing. We can distinguish between residential, commercial, and industrial real estate. Residential real estate is any property used for residential purposes, basically where people are living. So here we have single-family homes, condos, townhouses, multifamily homes, and so on. Usually, residential real estate is zoned together and exclusively used for residential purposes, and in very few cases you have commercial or industrial real estate mixed into these zones. Commercial real estate is any property used exclusively for business purposes. So this can be grocery stores, hotels, office spaces, and so on. Industrial real estate is any property used for manufacturing, distribution, storage, and research and development. So big factories, distribution warehouses, but also data centers from big tech companies where they process and store information. How to invest in real estate? Here I want to show you two ways how it's possible for you to invest in real estate. Starting with direct investments in real estate. So the most common thing is that people purchase a home for their own. So you live in a rental apartment for multiple years, and then you saved up some money and you decide you want to own your own property, and then you just buy a house. But this for sure can be seen as an investment, since the value of the property is very likely going to rise in the future. And instead of just paying rent, you just pay back the debt to the bank. And this is like the most common form of real estate investing. But you can also directly invest in real estate by purchasing a rental property, which means you buy an apartment or a house, but you don't live in there by your own, but rather rent it out to somewhere else. So you saved up some money, you have equity capital, interest rates are low, you borrow money from the bank, and then you use a house and a physical property to rent it out, profit from the rising value over the years, but also have some kind of dividend payments by the monthly rent which is flowing in. But on the other hand, you can also indirectly invest in real estate by investing in a so-called REIT. A REIT is a real estate investment trust, and this is a company that pools multiple properties together and offers partial ownership to its investors. REITs are like stock index funds, and they are publicly traded, and you can invest in such a REIT, and then you're a partial owner of a pool of properties, and you also benefit when these properties are rising in value, and many REITs are also paying dividends to their investors. And another way of indirectly investing in real estate are online real estate platforms like crowdfunding platforms, who pool together money to buy certain properties and then either let their investors participate on the rising value of the real estate or also pay monthly or annual dividends. What are commodities? What kind of commodities are existing and how to invest in them? Commodities are raw materials and physical goods used widely in society. So you deal with commodities every day. So in the morning when you get up and you brew your coffee, coffee is a commodity. When you look on your smartphone, there are multiple materials in there which have been extracted from the earth and then used in the phone, like for example silicium and other commodities. Furthermore, you can think of commodities like energy commodities. When you sit in a car and drive to work, this is also a commodity based on oil, or also electricity if you happen to have an electric car. Commodities are traded through so-called future contracts between producers and investors on liquid exchanges. What's a future contract? A future contract is a contract to buy a specific quantity of a commodity at a specific price, delivered at a specific time in future. So producers and investors, or producers and consumers, they agree that a certain commodity with a certain quantity is delivered to a certain price in the future, and this is already fixed today. But there's a lot of trading happening in between, so we have to distinguish between physical delivery, when, for example, a barrel of oil is really physically delivered to the buyer, but also the financial trading in between. Because usually, if we stick to the example of a barrel of oil, there are also financial contracts, and they change hands hundreds or thousands of times until the final delivery is happening. And this is all being done on liquid commodity exchanges. The overall asset class is a very well regulated asset class. It's kind of volatile, especially when there are big political upheavals or regulatory decisions, or also extreme weather events can have significant influence on commodity prices, and therefore the return profile of commodities historically have been quite mixed. There are so-called super cycles with commodities that their prices tend to move in multiple year timeframes. So from the 2000s on until like mid 2010s, they were rather decreasing. But since the late 2010s, commodities are actually increasing in prices again. And these are the so-called commodity super cycles. In this lesson, I want to share with you common commodities and what different types of commodities are out there. Starting on the top with gold. Gold is a very well-known commodity for investment purposes as a hedge against inflation, and but is also used in jewelry. Very similar to silver, is like the small brother of gold, also used as an inflation hedge, but plays as well a very important role in the semiconductor industry and is used heavily, for example, for producing solar PV modules. Platinum is a very interesting commodity as well, which is used for vehicle emission control devices, so in the automotive industry. Copper, basically for wiring infrastructure, so for electronic devices, but also like big transmission lines to transmit energy. And palladium is a bit similar to platinum. This is mainly used for catalytic converters and has also seen rising popularity in recent years. And all of the top commodities I was talking about now are in the so-called metals area. So they are called metals. In the middle, we have natural gas, crude oil, coal, ethanol, and electricity. The fossil fuels, gas and oil, which are mainly produced in the OPEC countries, but also like Russia and the US. Coal, which is unfortunately still a very important commodity, but quite toxic for the environment. China, Australia are big producers of coal. Ethanol, like as a bio alternative to these fossil fuels, but also with its disadvantages, mainly produced in Brazil. And also electricity, which is classified as a commodity and can be traded on so-called energy exchanges. And all of these commodities are in the area of energy commodities. On the bottom, we have cotton, lumber, coffee, cacao, and cattle. Cotton mainly used for producing clothes, lumber for in the construction industry. Coffee is pretty self-explanatory. Interestingly, coffee is one of the biggest commodities by trading volume because it's so popular and everyone around loves just drinking coffee. Cacao, similar, which is mainly produced in Latin American countries, but also Asian countries. And you even can invest or trade with cattle. And all of the commodities in the bottom are so-called agricultural commodities. In this lesson, I want to speak with you about the historic price movement of oil, in this case WTI crude oil, in the time period from 2000 to 2022. So when we start on the left, you see here around the 2000s, the dot-com bubble was bursting, and shortly afterwards, oil prices were declining as well. Then around this time, 9/11 was happening, and the US decided to go to war in the Middle East. And this led to steady increase in oil prices. Here around 2001, towards the end of 2001, oil was around $20 per barrel. One barrel is defined as 159 liters. And as you see, after the US decided to go to the Middle East for war, the prices were rising here on more like a healthy trend, but then here turned parabolic and hit an all-time high at about $150 per barrel in 2008. Interestingly, just a couple of weeks before the Great Recession hit, and then oil prices were falling like a stone and lost about 80% of its value due to the Great Recession, and were falling from $150 per barrel to about $30–35 per barrel. They bounced back pretty quickly, but never reached these levels of $150 per barrel again until today. Then in the mid-2010s, we also see sharp drops in oil prices, which resulted in probably the craziest event in the history of oil. That in March and April of 2020, when the Corona crisis hit the world, and the whole world was basically shut down, everybody locked in at home, no cars driving, no planes flying. The demand for oil was wiped out overnight, and prices turned negative. This has never happened before in the history of oil, and for WTI it was a couple of dollars negative, but in the Oklahoma hub in the US there were even negative prices of $40 per barrel. So people would have given you money if you bought their oil or if you took their oil. Nowadays, we saw a huge rebound of oil, and this is due to two reasons. First of all, we have a COVID rebound, so the economy is recovering, businesses are opening up, people go back to work, to the offices, are driving, more planes are flying, and this kind of stuff. But also on a less positive note, since February 2022, we have this Ukraine crisis where Russia was starting to invade the Ukraine. And since Russia is such an important oil producer and also a gas producer, this drove a lot of uncertainty and fear in the markets, and led to an increase in oil prices to up to 130 barrels. Now in the recent days, prices moved back to about $100, but this crisis in Eastern Europe is really very uncertain, and many experts predict that oil prices could reach new all-time highs and go above 150 or even reach $200 per barrel. What I wanted to show you here in general with this chart is that we have huge movements within the oil market, like from 20 to 150 back to 30, even to negative prices and up to 130. And this should give you an indication that if you are considering to invest in oil or other commodities, that they tend to be quite volatile, but this volatility is not playing out on a daily basis, but rather on a multiple year basis, what I call the super cycles. And this is something to keep in mind, since oil and other commodities are not so useful for day trading, but rather if you have a multiple year time horizon of trading and investing. In this lesson, I want to speak with you about digital assets. This is an emerging new asset class with great potential, but very, very high volatility. The most popular digital assets are crypto assets like Bitcoin and Ethereum, but there are others, like thousands of crypto assets out there, and maybe you even already have heard about concepts like DeFi, NFTs, DAOs, and so on. And we're going to touch upon these concepts in detail in module number 6, where we speak about blockchain and crypto assets. The use cases of digital assets today include store of value, that people want to store a part of their wealth in crypto assets. It doesn't need to be necessarily volatile assets like Bitcoin or Ethereum, because there are also so-called stable coins out there which tend to hold their value. And this is especially interesting for people in emerging or developing countries, which often suffer bad local currencies and constantly lose purchasing power. Mobile payments, since it's electronic peer-to-peer cash, you can send it around the internet on a global scale very fast and in most cases cheaper than with centralized intermediaries like Western Union. Decentralized finance is a concept I briefly touched upon. Basically people within the DeFi space want to build a decentralized alternative to our current centralized financial system, but more on this in detail later on. And the tokenization of physical assets is also an interesting use case where you can, for example, tokenize artworks and have partial ownership and trade this partial ownership on certain exchanges on the internet. Since its inception in 2009, Bitcoin and the overall crypto market experienced multiple boom and bust cycles. While some people made fortunes, others got broke, and this asset class is having enormous potential, as you will learn later on. But you need to be also super careful when you invest, where you invest, and don't fall for the scams which are unfortunately out there all over. And in the next lesson, I want to give you a glimpse how the top 10 crypto assets performed over the last 3 years.
In this lesson, I want to briefly touch on the previous performance of digital assets like Bitcoin, Ethereum, and other crypto assets. So you might wonder why this gentleman on the top right is shouting wow and is so surprised. And this is the case because if you look at the returns of the crypto assets over the last 3 years, they're above average and they go into the hundreds, even thousands of percentage gains. Starting with Bitcoin, over the last 3 years, you had a gain of 170%, with Ethereum over 800%. And if you look at smaller coins like Dogecoin, Solana, or Polygon, they even had multiple thousands of percentage of gains. So if you might wonder why these coins in between have very little change, this is because these are stable coins and they are designed to hold their value over time. So before you start to invest right away into crypto assets, I would encourage you to do your homework and be aware of the downsides of digital assets. They tend to be super volatile and the bull and bear cycles are brutal. So within bull cycles, you can have gains of like multiple hundreds or even thousands of percentage. But in the bear cycle, many cryptocurrencies lost all of their value, or 60, 70 or 80%. So you need to be able to deal with emotions and find the right timing to enter and exit the market. So I would leave you with a quote from Warren Buffett, because he said, if people are greedy, you should be fearful. And if people are fearful, you should be greedy.
Index funds and ETFs. These are a quite popular way of investing for the average investor who doesn't want to spend too much time picking single stocks and doing market research. And in the recent years, we could see a shift from actively managed funds or investing in single stocks towards index funds and ETFs, which track an index fund like the S&P 500 and have a moderate risk to return profile. So basically, in the case of the S&P 500, earlier on, we learned that the average return on an annual basis is 8%. And this is where you usually outperform the inflation and you track the economic activity of the US economy in the case of the S&P 500. The difference between an index fund and an ETF, an exchange traded fund, is that while an index fund is only cleared and settled once a day, that means that you have one price per day. An ETF can be traded like a stock and is changing its price constantly during the time when the stock exchange is open. And so you have higher flexibility to enter ETFs compared to index funds. But in general, for the majority of retail investors, it's sufficient to have one price per day where they decide to buy or sell an index. As mentioned earlier, this is a very popular passive investment strategy with lower expense ratios than actively managed funds. Because while actively managed funds, where professional asset managers manage your funds, usually take 1% expense ratio or even 2%, ETFs and index funds usually have only 0.2% or less than that as a management fee. And index funds and ETFs can track different assets like stocks, a basket of stocks, or also bonds, commodities, or since recently there are even index funds out there which track digital assets like Bitcoin, Ethereum, and so on. In this lesson, I want to share with you different types of index funds. Here I displayed 4 of them. One type of index fund you can invest in are so-called commodity indices. They can track metal commodities like gold, silver, palladium. They can track energy commodities, coal, oil, gas, or agricultural commodities. Another opportunity and option for you is to invest in an index fund which is tracking domestic stock markets like the S&P 500 in the US, or even a continental stock index like the MSCI Europe, which is containing the biggest companies across Europe. And a very popular index fund is the MSCI World, which is containing the biggest companies worldwide and representing them based on market capitalization. So you can spread your capital in a quite diversified way by choosing to invest in index funds or ETFs. Private equity as an investment class or as an asset class. Private equity basically means that there's a direct investment made in private companies. This is also often called angel investing or venture capital investing. Private equity is kind of illiquid, it's high risk, and the capital there is tied up to 5 or even 10 years. Private equity and venture capitalists saw stellar returns since the 2000s, and this was mainly driven by successful software and tech startups. There's a very interesting essay written by Mark Andreessen. It's called "Software is Eating the World," and I included it in the related links section. So have a look, and I encourage you to read it. There he really shared his investment thesis in software companies back in 2011, and quite eloquently describes why he thinks the return potential in venture capital for software and tech startups is so high. And he proved to be right looking back there. The thing is, it's pretty difficult to obtain access to private equity without being a so-called high net worth individual or accredited investor. In the US, you need to be worth at least $1 million without your private property to be eligible to invest in companies as a private equity investor. So many venture capitalists either are successful business people who sold their business and now are allocating their capital, or people simply working for venture capital funds, doing market analysis and then deciding where to put their money. Private equity investment areas. Here I listed you 3 different areas where you typically find private equity investors. Probably the most common and popular one is investments in startups and scale-ups. So basically supporting young entrepreneurs who have an idea but are in need of funding. As I mentioned before, Mark Andreessen with his venture capital fund, Andreessen Horowitz, is one of the most popular Silicon Valley venture capitalists, and they typically invest in software and tech startups. But there are hundreds of thousands other venture capitalist funds out there who focus on certain other areas. But private equity funds also can invest in established and private companies in the case that they're not publicly traded, to give them funding in form of corporate finance to either prepare them for a planned IPO, initial public offering, or just to give them money and get equity in return, since the future perspective of the company is positive and they intend to sell this equity later on to other private equity investors. And it's also possible that private equity companies invest in so-called distressed companies, companies which are in trouble and have problems getting funding from banks. There, sometimes private equity funds, you could also call them restructuring funds, jump in, give money to these companies and want equity in exchange. And this can be a very lucrative deal for private equity companies, because most often these companies, they are in trouble and are willing to give away equity for a pretty cheap price. And usually these private equity companies are exchanging the management in these companies. And when the management turns around the business and is making it successful again, the equity is rising as well in value and they can earn a lot of money. So these are the three main investment areas where you can find private equity investment companies or private equity investors on an individual basis. Cash as an asset class. So is cash really an attractive asset class you should consider investing in? Let's ask one of the most popular investors in the world. Ray Dalio doesn't think that cash is very appealing, and he coined this term, cash is trash. So let me explain. Dalio is a student of history in financial markets, and he came to the conclusion that over years, cash is constantly losing its value since inflation is putting away purchasing power from individuals if they are just holding cash and not invest in other assets like stocks or real estate. So Dalio thinks a certain amount of cash should be part of every portfolio, but this amount should be kept rather small, that you have powder to buy more stocks or bonds or other assets if they are falling in price. Let me just give you a brief description what cash actually is. I mean, cash is officially fiat money. So these are official fiat currencies which are issued by national governments. So the US dollar, the euro, the yen, these are all fiat currencies. Fiat from Italian, Latinum, fiat, there will be light. So basically they are created out of nowhere, and they used to be tied to gold. But as we learned earlier on, President Nixon moved away from this gold standard in August 1971. The relative value of cash is affected by many micro and macroeconomic factors. So basically, fiat currencies are representing the economic strength of a country, and also like the credit worthiness, similar to bonds, what we learned earlier on. And over, we experienced that especially unstable and corrupt countries in Africa, but also like Latin America, saw their currencies collapse. Some examples here include Zimbabwe, Argentina, or the most prominent one at the moment, Venezuela, where the inhabitants of these countries basically lose the purchasing power on a daily or even hourly basis, since their government is corrupt and incompetent. Currencies can be traded against each other. This is called forex trading, foreign exchange trading, and you can buy US dollar with euros or vice versa, and then profit from the increase or decrease of the other currency. This is kind of a large financial market, but quite honestly, I think it's not very appealing to speculate on rising or declining currencies. And therefore, this is the only slide I want to share with you here regarding cash, because it's not really relevant for the further progress within our course. Here on this slide, I want to show you the risk to reward ratio of the asset classes we've discussed here in this module. On the x-axis, you can see the potential reward, and on the y-axis, you can see the risk associated with the asset. So starting at the bottom, I placed cash. So cash has a very low risk potential. The value of cash is kind of stable. It's affected by inflation, obviously, but inflation usually moves between 2 and 5%, and therefore the value stays pretty stable, but you also have a very low reward potential. Second, bonds. Bonds tend to be a bit riskier than cash, but also offer higher reward potential. And within bonds, as we learned, you can distinguish between stable corporate bonds like from Germany or Switzerland, all the way to very unstable ones with bad creditworthiness like Argentina. So bonds deliver a bit higher returns, but also are more riskier than just holding cash. Then I placed commodities, which pose a higher risk, especially due to great political decisions or extreme weather events, which are very hard to predict. And therefore, the risk to reward ratio for commodities is not optimal, in my opinion, because the risk is kind of outweighing the potential reward, since commodities are also kind of slow moving and therefore are not the most appealing asset class in my opinion. Real estate has a kind of a balanced risk to reward potential. Real estate turned to be out a great investment over the last 15 to 20 years due to the high amount of leverage you can use from a bank. The risk is rather low depending which area you choose, obviously, but you can be handsomely rewarded if the prices of the real estate and the properties are rising, and you're able to also adjust the rents accordingly to rising prices. Index funds and ETFs are kind of the perfect middle of everything. That's maybe the reason why so many people feel attracted to invest in index funds and ETFs, because they offer a really moderate risk to reward ratio, since they diversify within different indices or different stocks, and can be seen as best choice for passive investors who don't want to spend a lot of time doing research in the markets. Riskier than index funds are stocks, because you really need to read income statements, do technical analysis, really dig deep and do research if you want to invest in single stocks, especially in the growth stock area. But at the same time, they offer higher risk potential, higher reward potential than index funds do. On top, so the riskiest bets you can take, but also the ones with the highest reward potential, are digital assets like crypto assets and private equity. Here, I put private equity even above digital assets, since the failing rate of startups is about 90%. So 9 out of 10 investments turn out to be failed investments in the private equity, in the startup space. And if you focus on big crypto assets like the top 10 we saw earlier on, I think that the success potential is higher than investing in any other startup. So this graph should give you an overview again about the asset classes we discussed and where you would like to place yourself in terms of how much risk you're willing to take, but how much reward and return potential you also looking for. Yeah, you have seen this slide in the beginning of the module where we spoke about all the asset classes we cover in this module. So again, you learned about stocks, how to invest in them, what kind of bonds are existing, what different forms of real estate, residential, commercial, industrial. We talked about commodities, metals, energy commodities, agricultural commodities, digital assets like Bitcoin, Ethereum. Were astounded about their returns. We learned the difference between index funds and ETFs. Also covered private equity, why it's kind of hard to get into private equity, but it also offers great return potentials, and also why cash at the moment might be not the best option for you to invest in on a big scale. What I would like to close this module with is that going forward, we're gonna exclusively focus on these two asset classes, stocks and digital assets. Stocks mainly distinguishing between value stocks and growth stocks, what we learned earlier on. Since all the exponential technologies you will learn in the upcoming modules, I'm gonna present you publicly traded companies. Mature established ones we consider value stocks, but also recently listed public companies, which are definitely within the growth area. So we focus on stocks there. And on digital assets in module number 6, we cover blockchain technology, how it works, but also speak about in detail about cryptocurrencies like Bitcoin and Ethereum, and also further use cases there. So I hope you enjoyed this module on different types of investments. I encourage you to take the quiz and wish you fun and success with the upcoming modules.